High growth stocks are once again feeling pain here in the market, guys. And it's quite simple. If you're a high growth stock and your profitability is many years out, the market's looking for a couple of things. First, it wants to see how are you going to report on your earnings. Are you going to beat? Are you going to raise? If not, punishment. The second thing is, yeah, maybe you're not profitable on the bottom line, but they want to see positive free cash flow. And if you can't deliver on that as well, again, that could result in some cuts in valuation. Well, the stock today that we're talking about is actually down around 50% from its all-time highs, and it actually just reported their earnings yesterday. It's a company we've talked about on the channel before, and I think it's quite an interesting business if you are a long-term investor. The stock is UiPath, ticker symbol PATH, and it's definitely a high-growth name that's high up on my wish list because their metrics are very impressive. From a high level, the company grew their ARR, annual recurring revenue, to $818 million now, and the growth rate actually increased by 58% year over year, which is a very strong showing for this business. One powerful metric to look at here is their customer growth, which went from 7,800 to over 9,600 year over year. So a lot of businesses are realizing the true power and savings that UiPath can provide them. Large customers spending 100,000 plus increased to over 1,300 customers, very impressive. But what's even more impressive is the customer spending over 1 million, the holy grail for SaaS. And this is sitting at 135 customers, which is almost a double up year over year. So that's pretty interesting. It's clear to me that customers are kind of flocking here to UiPath. It is a competitive space. There are competitors like Automation Anywhere is a big one, even Microsoft fights to have a piece of this pie here. So competition is there. It is kind of fierce, but UiPath is showing that customers are still choosing them. They're spending a lot with them, and they're growing with UiPath over time as well. So one metric we can actually use to see how much money customers, existing ones, spend year over year with the company is something called net retention rate, NRR. And this is something you'll see a lot of SaaS businesses report on because it tells us as investors how sticky their product is and how much customers love it to the point where they're spending more on their product year over year. Previously, UiPath would publish the net retention rates front and center and would be one of the proudest metrics for them to flex because their net retention rate was 144%, absolutely amazing and industry leading. But interestingly, this quarter, when looking through their earnings, looking through their filing, I didn't see much of a mention or any mention of net retention rate, and that kind of left me scratching my head a little bit. Why remove that? Now, I'm clearly not the only one that thought this because on the conference call, an analyst did ask the company, hey, where's the net retention rate? I didn't really see it. And what they said in response was that in terms of net retention rate, we see no material change from our last quarter. And then the CFO actually goes on to state that they will release the actual net retention rate periodically. That's kind of weird to me. I don't know, maybe I'm looking into this a bit too much. Maybe I'm making it a bigger thing than it actually is. But, you know, if you have strong net retention rates, 144% is very impressive. Why wouldn't you just publish that front and center? It's differentiating you from all the other high growth SaaS companies out there. It's a strong metric. It's respectable. So it's kind of weird to me that they would just remove this from their slides and, you know, have no mention of it. But maybe, you know, it felt like 143%. You know, CFO said there's no material change, and 144 to 143, not really a material change. So maybe that was it and they didn't want to show that it actually went down slightly and, you know, have negative press around that. So they just removed it altogether, and they may add it again in the future when, say, it's still at 144 or even rises higher, 145, 146. That'll be something to throw in there to bump the stock up a little bit. But either way, you know, we can just speculate on this. We just have to take their word for what it is. It's pretty much in line as to what it was before, 144%, which is still very strong. Okay, so UiPath had a good Q3. They grew well. Customers are still growing. Net retention presumably is also pretty strong. So how does their guidance for next quarter look? They expect ARR to come in just over $900 million, which is a raise to their previous guidance, which was in the high $800 million range. So this is a very bullish sign. They also expect to be profitable in Q4, but their focus, guys, is still reinvesting into the company. So this was actually very good to see. The company not only raised their guidance, which tells me there's a lot of demand for their service, but they also mentioned profitability, which is what investors want to see. Now, based on this earnings, I would have thought the stock would have probably gone up a bit today because they did kind of hit on what investors are looking for in this market. But unfortunately, growth stocks as a whole were smashed down today. A lot of them down 2, 3, 4, 5. Coinbase, I think, was down like 8 or 9%. They were down across the board. So UiPath was only down around like 1.5%. So all things considered, it actually held up quite well. But now one thing you need to understand if you're going to invest in this company is that while they may be profitable next quarter, their goal, at least for the foreseeable future, is to kind of remain cash flow neutral. They don't really care about making a whole bunch of cash flow right now or losing a bit of money right now. Kind of irrelevant to them because they want to spend as much as possible, they want to reinvest in the business as much as possible, and they will worry about profits later down the road because they're confident that it's going to come over time. So just keep that in mind. You know, in this new market, free cash flow is kind of very important. It's king. Investors are looking for that. So this could be a stock that's kind of out of favor for the foreseeable future. But if you're an investor that's looking long term, a few years out, you love SaaS businesses, you love the metrics of this company, which I do, it's worth considering to maybe start building a position here. Now with this earnings and with any earnings, analysts will come out and give their 2 cents as well. So far it seems to still be satisfactory here with around a 64% price target as consensus, and this signals a 37% upside on this stock. Now a ton of big firms reiterated their stance on, if they want to keep holding or buying or whatever. And what's interesting is that even the more bearish analysts here have a price target of $50. That's kind of the low bar here, and it's still above today's stock price. So when I saw this, I thought, okay, this looks pretty good. Analysts are still pretty optimistic here. Price targets range, in the 50s and 60s for the most part. Looks good. But then when I dug a little deeper, there was actually some downgrades, but they just maintained their buy or hold rating. Wells Fargo, for example, lowered their rating from $65 down to $50. This is kind of the new low out there. Bank of America lowered theirs from 75 down to 62, so that was pretty drastic. And another big one was Evercore, lowering theirs from 72 down to 57. And this kind of goes for quite a few of the analysts on that list as well. A lot of them actually revised their price target down, even though they maintained their buy or hold ratings. So what that tells me is that, they are optimistic on the business, but they don't think this company is going to outperform massively here over the next year. And that could be a result of, what's happening in the market right now with liquidity tightening, high growth stocks not being in favor, that kind of stuff. Maybe they're accounting for that. But either way, the conclusion I guess we can draw here is that Wall Street may not be as bullish as they were before with their price targets, but they are still overall optimistic on the company. But now that being said, I thought, we'll look at the full picture. Let's look at the 13F filings from Q3 when it comes to UiPath. We can see here that institutional ownership is over 56% now, up from 37% last quarter. So while their short-term analyst ratings may not be super strong, it still looks like these funds, these institutions, are willing to bet big on this company regardless. Now, me personally, I was actually quite satisfied with their earnings. They reported strong growth, strong ARR, net retention presumably is also in line. Their guidance I thought was very strong with a raise. Everything, checks my boxes here for a company that I would consider as an investment. Now, would I make this stock kind of like 10%, 20% of my portfolio? Probably not. There's a lot of risk that comes with this company because, again, they are not making a whole bunch of money right now. So you got to keep that in mind when allocating the stock in your portfolio. But one thing I do understand here with UiPath is that it's not just a game of short term here with this company. It's a long-term game. Customers are investing today, and the value is actually realized a few years from now when those customers grow or they expand in other sectors of their business and they start spending more and more and more with UiPath. That is, I think, when we will see the true potential and the true dominance of this company, because that is when the real money will be made. So I think right now just kind of laying the seeds. It's still early on. You got to give it time. You got to be patient with this. This could dip quite a bit more. If it does, I'd probably be even more interested. But either way, as of recording this video, I just want to disclose I do not own this stock, but that may change in the near future. Anyways, guys, hope you enjoyed this video. Don't forget to invest positively, and I'll see you in the next one.